Yeah, start recorded. Erica, the floor is yours.
Okay, so let's start. So good morning, everyone. So welcome to the Accounting Design Project Budget event. So my name is Haruka Amma, at Sriniwas in Japan, and I'm moderator today's session. I look forward to working with you. So the title of today's presentation is Decomposing Firms Revenue into Price and Quantity. So and the presenter is Professor Sriniwas from the Institute of Technology. So prior to the presentations, so I would like to make a brief request. So first, please keep your microphone muted to avoid noise. So, and if you have a question and comments, raise your hand or use the chat box. So please do not ask a question for 5 minutes, each at the beginning and end of the presentations. So, Professor Sriniwas, so if you are ready, please give your presentation.
All right. Thank you, Haruka, for moderating it, and thank you for Ayung for inviting me to present. It's an honor. So this paper is titled "Decomposing Firms' Revenue into Price and Quantity." It is a joint work with Professor Shiva from Columbia and Prasanna and Pratik from Indian School of Business. So I'll start right away with some motivation around it. The first question that comes to our mind is, do firms really report product level quantities sold and revenues earned? Then let me give some anecdotal evidence around it. So here's a snippet from 2018 about Apple. When Apple stopped reporting how many iPhones, iPads, or Macs that they are producing or selling, how many the quantities that this stopped reporting. And on the same day, the stock went down by roughly 7% in the aftermarket trading. Um, this nudged us to look at the 10Ks of Apple. What exactly did they stop reporting? So here's the 2019 10K, after they stopped reporting, and this is how it looks. They have the total sales number and which they have, kind of broken down into the important products, your iPhone, iMac, iPad, and a few other stuff. And what is the percentage contribution from each of these products in the total revenues. Now, going back another year in 2018, what we find is the same kind of revenues by each product category is still available, which you see, the total revenue is 265, 595, and it's basically, most of it is coming from iPhone, iPad, iMac, and stuff. But in addition to that, they also are providing how many units of each of these products were sold. Now, that kind of gives you an idea, you can even back calculate, what is the average price at which each of these products were sold. Now, this is the kind of information that they decided to stop reporting and which eventually which came out in the press. Now, this is not the only case. This has happened with a few other companies too. There's a similar story with Netflix. I think this happened just more recently when they decided to stop, disclosing the subscriber count, which is basically their unit of products. And on the same day, the stock price of Netflix even went down by roughly 6 to 7%. Similar was also the case of Meta. There are a few other cases. But most importantly, what we found was this product level quantities and revenue disclosures are largely voluntary. It is not mandated. So given that, the questions that come to our mind is, what information does this quantity and prices of product level units sold actually contain? Does it talk about maybe the demand for the product or what exactly it has? And then with whatever information it has, is it really value relevant? Does it improve market efficiency? Now, these are the questions that we are trying to address in this paper. And the research setting that we have around here is not very straightforward because, as I said earlier, the product level quantity and price disclosures are largely voluntary. So because they are voluntary, and the companies can do it when it's in their favor to do so, or otherwise they can stop disclosing it. Very few companies actually do it religiously. I think Caterpillar is one such company which does give a very good breakup about product level growth and price level changes. Uh, Given that it is endogenous, it's difficult to assess what is the impact. And so we need a setting where the disclosures are basically maybe mandated. So that's where the Indian setting helps. So in Indian accounting standards, manufacturing firms were mandated to disclose this product level revenues and quantity sold, audited level information, and as part of their audited financial statements, annual reports. Now, this disclosure was there up till 2011, and from 2012 onwards, these disclosures were discontinued. Why they were discontinued? Well, basically, India was trying to move towards adoption of IFRS in the future. So, as part of the IFRS reporting format, there was no need of this, and they kind of stopped disclosing it. So this kind of setting allows us to examine what exactly is the information content in these disclosures and whether this information is value relevant or not. Quickly, before going into the paper in detail, I'll tell you about what we have found. So what we find is that these disclosures of unit product level quantities and prices actually reveal the shifts in demand for product or the growth in demand for product. Subsequently, this shift in demand or the demand information that you can deduce from the quantities and prices information actually tells you about whether the sales growth will be more persistent or not. Specifically, what we find is if the sales growth is driven by quantity growth, it is more persistent rather than when it is driven by price growth. Because sales can be generated, in both ways. Either you can have a quantity growth or a price growth or a combination of both of these. And of course, some part of it could also be due to FX changes, if you have a lot of exports and imports. But majorly what we find is if the quantity growth dominates in the current sales growth, then it leads to higher sales growth in the future. And this information also, it improves the stock price efficiency in the way that what we find is we have two pieces of evidence here. One, we find that the analyst's revenue forecast error are lower when these disclosures are present. And the market reactions to earnings announcements is also less volatile, or market reaction is more accurate when such kind of disclosures are available. Now, let me go into an illustration of the data that we have. So I've taken one example for better understanding. So this is Tata Steel, which is a Fortune 500 company and the largest steel manufacturer in India. So 2011 is last when this regulation was in effect. And let's have a look at how their income statement looked like. So this is the top line of their income statement from 2011. Which talks about sales and other operating income, roughly 31,900 crores. So a crore is like 10 million. So you can say 319 million rupees. And then when we go into the schedule, they talk about that out of these 31,900, roughly from the products, they are mostly getting like 90% of it, 30,747. Now, this is the usual, it's similar to whatever income statement we may check in for other companies in other jurisdictions. But on top of that, what they provide is they provide this a schedule where they are actually breaking this revenue into each of the products that they have. Roughly, there are 13 different products. And not just the revenue, they're also providing this information about what is the quantity that have been sold in tons here. So basically, we have like 13 different products, which have been like some of them are like saleable steel, bearings, and so on and so forth. And they are giving this detailed information of how much revenue from each of this product and how much quantity from each of this product. So this essentially also allows us to, kind of deduce what is the average price at which each of these products was sold. Now, a year ahead in 2012, when the disclosure is not available, well, they still have the similar income statement, when they are following the IFRS kind of format. But on top of that, they don't provide this product level quantity information. They still provide the revenue information for each of these products. Even this is voluntary, by the way. But they don't have to give the quantity of each of these 13 different products that are there. So this is the yes. I You have a question.
Do you want to finish your sentence?
Yes. So I was saying I was just meant to say that this quantity level information is not available from 2012 onwards. You can go ahead.
Yeah, so I told you that I reviewed your paper for the mid-year meeting. So I really like the first result, which is quantity or revenue growth through volume is more persistent than the revenue growth through prices.
Mhm.
And one implication is this how persistent the earnings or revenue stream will be. And then the other implications that we have learned from the FSA class is if it's a revenue is actually growth from quantities, then analysts actually has more information to forecast CapEx or
Yeah.
acquisitions of long-term assets or human capital. But if
Mhm.
revenue simply just increases because firms are able to raise or increase selling prices, then there's no additional CapEx or fixed cost acquisition. So is there anything that you can do to actually also kind of shed light on the value relevance is not only coming from the persistent in terms of time series, but also help outsiders to forecast fixed cost?
Right. That's an interesting question. So right now we haven't done anything on the fixed cost, but we can have a look. That's it makes sense too. I mean, if you have the quantity information, you can also forecast way better, how much capex the company can do in the future. Is that what you're trying to say?
Yeah, and then that's kind of consistent with your Tata Steel's example on the previous
Right.
slide, right? If
Right.
you have those volume and then also how many have been sold, how many have been unsold, then you actually know how much more capacities you actually need to acquire compared to the existing utilization rate, right? So that's
Right.
kind of
Right.
like in the FSA, like usually what we teach our students will be two implications of decomposing revenue into price
Mhm.
versus quantities. Yeah.
Right. Thank you. I think we can have a look, if it gives some information about what the future capex is. Thank you. That's a great point. Yes. Uh, Professor Sudipta, you have a question.
Hey, so I have two questions. So broader question is about this idea that you need a mandatory setting because it is somehow not endogenous. And the question is, A, which firms are wanting it and which firms don't want it? There's going to be some cross-sectional variation.
Mhm.
So I think it's sort of naive to say that it's not endogenous. I mean, we see lots of examples of firms benefiting and firms being hurt by regulation. So clearly there's endogeneity in who gets to win in any given regulation. So there's going to be cross-sectional variation, which is endogenous, really, not exogenous.
Okay. Okay. In the Indian setting, I mean, it was an exogenous stuff. So we do look into if there is still some amount of voluntary disclosure later on, which I'll talk about in after a few slides. But as far as the regulation was concerned, all the manufacturing companies were mandated to provide this information. So that's
Yeah, but it's endogenous who pushes to get rid of it versus not, right? So,
okay. Okay.
and the second question was this price versus quantity growth. You can think of this also as a quality versus quantity trade-off, right? So if you have higher quality, creating new high quality products, you'd expect to be able to charge a higher price. So
Right.
do you have an economic story for why quality improvements are better in some way than quantity?
No, we have not specifically checked on, on the quality parameters, that might have implication on prices. But we do have some things that we have checked on, when prices might matter. especially in a when the competition to the farm is low. In those cases, we find that, quantity growth is not it doesn't have a high impact on future revenue growth.
Well, I mean, if you think about like, say, Porter's strategies,
Mhm.
brand versus cost, there's sort of arguments to be made that quantity matters more for someone that's a cost leader like Walmart,
Mhm.
and
Okay.
price matters more for someone that's, a brand like Tiffany's or Nordstrom or whatever.
Right,
And we
right,
talk
right.
about this in FSA,
Mhm.
right? Industry analysis and where firms are. So is it the case that, say, India specializing in the low quality end of the spectrum, say, compared to Japanese steel or Korean steel, or do you think of it as something else?
Okay. Okay. So there is one thing that we do, maybe it might partially help this. So later on, what we do is we also use this, bit of firm cross product fixed effects, which basically what it does is a firm which might have a same product, two firms having the same product, but one firm has a superior quality and the other might not have a superior quality. That will get maybe that will get subsumed in the of firm cross product fixed effect structure, and we show that even when we account for firm cross products fixed effects, the results actually still remain, but it's still an important point, that might quality will definitely have a say in the future revenue growth. But the way we have looked at it is we have tried to at least address that it's not just because of some other reasons that we are seeing these results. But I acknowledge it. I mean, we can check about what we can do in terms of quality and about the strategy. Yeah. Thanks, Sudipta. Yeah, Joshua, you have a question?
It's a comment. I actually like very much what you do by splitting it into price and quantity. But one thing that you may want to do is check what other companies in the same industry did in terms of, again, price and quantity. If everybody was able to increase quantity by roughly the same amount, that's different than if it's only the company that you are focusing on relative to other companies, because that means they're taking away market share. And the same story with prices. Is it something that happened to the economy as a whole that favor this industry and everybody was able to raise prices or decline? That's a different story.
Right.
And I haven't read the paper, I apologize, but that's one thing that I would do if I had to have done the study.
Right. So if I have to reiterate, you're saying, what if, everybody follows the same strategy in the industry, right?
What I meant was you want to look at your particular company relative to other companies in the same industry.
Right. So we are using that. We are using some industry fixed effects to say that it's not just an industry trend. So maybe that will address it when I come to the empirical specification.
Okay. Again, I'm not sure that the fixed effects would do the trick, but okay.
So what if the,
Sriniwas, he's trying to
government
help.
issues tariffs, right? So I mean, think about, say, the Trump tariffs on steel. That's going to affect prices and quantities in predictable ways. But an industry won't get it. You need an industry year at a minimum then to get to that.
Okay.
Probably even product year level.
Right. So so we do all these tests at the firm product year level. So maybe that will address some of it. But thank you. I mean, I think we can.
I mean, you can identify this directly instead of controlling for it. You can sort of measure, all the tariff laws and sort of see whether these changes occur as you would expect and what that implications that has for growth.
Okay. Yeah, that's something interesting. Okay. Thank you very much. Let me listen. Yes, Salman, you have a.
Yeah, thanks. Interesting paper. I was curious, the nice thing about this setting is it's basically homogeneous in the sense that your input is relatively kind of similar across firms. And so it seems like you could get an estimate of the pricing power because you can look at the sort of price of steel as it moves over time, and then how much are the prices that these firms are charging for their products, and sort of maybe figure out like what is the pricing power of these companies. So anyway, just kind of a thought that you could leverage that information. Also, the input price, right? You're measuring the output price.
Yes, we are measuring the output price here, but I think does this goes back to something like what Sudipta said in terms of quality and the pricing power?
Sure. Yeah.
Right. Okay. Thank you, Salman. I think it's, okay. There are. I'll go ahead.
Okay, so Professor Siva, do you have additional comments?
No, I'm fine. I don't want to interrupt him, but Sriniwas, I was just trying to say that Joshua and the others are trying to help help us. So, fixed effects are the story in some cases, right? You don't, yeah.
Right.
That's all I was trying to say.
Right. Thanks, sir. Okay. So a little bit on the literature. It is so this is definitely a public disclosure story. And there are ample amount of papers that have talked about that disclosures reduce information asymmetry and they improve the efficiency of markets. The theory papers around it and a lot of empirical papers too. But there is also another side of the story which talks about, it's not always the case that public disclosures are useful. Sometimes they can crowd out the private information production. Especially Morrisonson, they talk about that whenever there is high amount of public disclosure, it will actually disincentivize people to privately extract information, and in a way it can actually impact the market efficiency as a whole. So it is so in this case what we are appealing to is we are examining some specific information disclosure about quantities and prices, and we are eventually checking whether it is value relevant or not. And what we find is the disclosures for product quantities and prices are actually value relevant. So this is the data on the product level quantity and prices. It's not first time we have used, it has been used in some economics paper by D. Locker and Bao and Matre. So what it provides is you have the firm, product, and the year level information for revenues and quantities. And that helps us to actually calculate the year-on-year sales growth, quantity growth, and price growth for each product for each firm in the year. So we calculate the changes and then we check how the quantity growth changes or the price growth changes impacts the sales growth changes in the future year. So we create a variable called as quantity growth factor. So basically what it does, it calculates a proportion of revenue growth that is explained by quantity growth. It is a percentage of change in quantity divided by the sum of percentages of change in quantity versus change in price. It effectively tells you how much proportion of the revenue growth is explained or is due to the quantity growth alone. It kind of proxies a demand shock in a way that when I say that this ratio or the quantity growth factor is 1, it means that the entire sales growth is driven by growth in quantity. And when it is 0, that means the entire sales growth that the firm has experienced or the product has experienced is because of the price growth only. So a higher value of this growth factor would suggest a higher contribution of of the demand-led sales growth to the overall sales growth. Salman, you have a question? Sorry. Okay, okay, I'll go ahead. So this is a sample construction. So we take around about, from the liberalization period, from 2002 till 2011, when the disclosure regulation was mandatory. After the cleaning of all this data, we have roughly around about firm product pairs of 33,000 firm product pairs that correspond to 11,000, that's 11,800 firms and some 23,000 products. And for the market efficiency test, we go ahead and check revenue forecast from Refinitiv, and the stock price is from the usual CMIE prowess, which is used by most of the people who work on the Indian data. Then we have the market level index information from NSE website. We calculate revenue forecast accuracy from Refinitiv, which is basically the actual revenue that the company posted minus the consensus revenue estimate divided by consensus revenue estimate. We take an absolute value to know whether, how large the difference has been. It could be either way. It could be positive or negative. We want to see, what is the magnitude of this forecast errors. On top of that, we use the standard, cumulative abnormal return around the earnings announcement date. Again, there we use several benchmarks. We use the standard market return or the CAPM or the 3-factor model or the 4-factor models, and then we again take the magnitude of it to find out what is the quantum of this abnormal returns that the company experienced around the stock experienced around the earnings announcement date. Yes,
Yeah, please.
I have a question that about 2 slides before, can you go back about quantity growth as a percentage
right.
of total revenue growth? I kept thinking about the demand curve has a negative slope. So usually the quantity growth or year to year change percentage usually has a negative correlation with price. So think about when the firm raising its selling prices, the volume would decline, and then when the firms actually provide a lot of promotional discounts, the volume would go up. So
Right.
I just keep looking at that third bullet point about between 0 and 1, and then I just need some rationale about what this ratio actually represent. Yeah.
Right. So, I mean, the 0 and 1 are the extreme cases in these cases, but simultaneously, I mean, we checked for like, cases like where prices have declined, quantity have increased. Say if I take your case of where prices have declined, even in that case, I would have like a quantity growth factor of, say a percentage change in quantity went up, but the percentage change in prices went down, so which goes into the denominator. So this will again be it will not turn out as a perfect one. The perfect one is when the sales growth is driven by demand, is driven by the growth in quantity. But it tries to tell you, relatively how much it is doing. So I don't know if I did a good job in talking about this measure. What I wanted to say was it was this percentage change in quantity divided by the percentage change in quantity plus percentage change in prices. So the percentage change in prices can be negative. Percentage changes in quantity can also be negative or positive. So relatively speaking, it's a hypothetical scenario. But when the percentage prices is say 0, and the entire and the percentage quantity growth is what the only thing that the company has say witnessed in a year, then it gives a value of 1.
Yeah, but like if you have a discount when your selling price growth is negative amount, then your quantity growth has to be more than 1 to compensate the negative growth from
Yes,
price, right?
Yes, it could be more than 1.
Yeah, I don't think it's bounded between 1 and 0. Yeah. Anyway,
Okay.
I
Okay,
think
yeah, it's not bounded between 1 and 0. I understand. But if the quantity growth is even in that, I think there will be 2 cases. Yeah, I stand corrected. Thank you. It won't be bounded between 0 and 1. It can go above 1. But if say the percentage change in its prices is too negative, then it might even go to the negative side too, because your denominator will become negative in that case. Or just the one, when I talk about one, it's the case where it's an ideal scenario or maybe a hypothetical scenario where the entire thing is just because of quantity, nothing because of price. But in general, when I say it is increasing, would you kind of concur that it is because of more because of quantity growth than because of price growth is what you wanted to convey?
Is that a question for me?
No, I mean, I was asking, yeah, I mean, would you be convinced if I say that when it grows, when the quantity growth factor increases, that means the revenue growth is more because of quantities changes rather than price changes?
Yeah, I agree with that. But like, I think there's also more opportunities for you to actually think about the interplay between pricing
Okay.
strategies and the quantity strategies, instead of
Right.
treating them as two independent indicators, and then you only capture a percentage of one out of total. Yeah.
All right. Okay. Okay. I agree. Thanks. Yes, Sudipta.
Okay. So
I think Mark had his
please.
hand up first, so I think.
Okay.
Well,
Yeah,
thanks.
please. I couldn't say that.
Yeah. Interesting, really interesting paper. I was curious if we could talk about what the data looks like a little more. In particular, if the firm has several different product mixes, do you pretty much have complete data on price and quantity measures for these different product mixes? And I guess ultimately, how well does the comprehensiveness of the price and quantity data you have map into the firm's total revenue?
Yeah, so it matches into almost of the entire revenue. So unless it comes from some services, which they don't have to then give the detailed breakup. Otherwise, for quantities, at least we have like roughly what 30,000 different 23,000 products that we have. So and there is the same product that is carried by different firms. So that kind of information we have. As long as it's a manufacturing firm and it's a tangible product, this information is available.
Great. Is there a materiality threshold, or really for any level of product mix they are required to disclose this
That
data?
I'm not very sure of, but what I found is when there is a product, say a toothpaste, they don't give like, a toothpaste of, what size or what variety, but it's just toothpaste, this much revenues and this much, what is the quantity. They don't go below that, like different grades of toothpaste or different, sizes of toothpaste that they don't. But in terms of the product descriptions, it's quite exhaustive.
Thank you. So final thing, it would be, you mentioned if services represent a sizable portion of the firm's revenue, that's when this data would not map as completely into total revenue?
Yes,
Okay.
then it will not matter. So for instance, right, in the Tata Steel example, they had some other operating income, which was actually a very small part of it, which they don't divide into, into different products.
I see.
And
Great,
it's
thank you.
given this income from town.
Thanks.
Yes, Aditya.
So I put in the chat as well, but I think you're missing a term in this ratio, which is the product of the change in price and the change in quantity.
Yeah.
Right. And so it's clear that it should be in the denominator. What I'm not sure is whether it should be in the numerator, because that portion is affected by both price and quantity changes. And so I'm not sure exactly how you're thinking about quantity and the impact of change in quantity. Is it independent of the change in price, which is this cross product, or is it right? I mean, so I think you need to clarify that to make things clear to us.
Right. That's a great question, Sudipta. So we actually struggle to actually find what is the component in the product term. But, so in the denominator, we tried rather than the sum of the percentage change in quantity and the percentage in prices. We also use the entire percentage change in sales, and that doesn't, change anything materially. But in the numerator, I mean, it's very tough to actually find out from the product term of change in quantity and change in prices, how much is exclusively because of change in quantity. So, but the only thing that I can say is that it is usually a very small term as compared to the standalone, changes in quantity and prices. But we agree, it's it's a limitation. It's very difficult to find out from that third product term how much is exactly because of quantity. So
But we need to distinguish between theory and empirical constraints, right? So what is the theoretical measure? And then given the data constraints, what is the best you can do to approximate the variable of interest? I think that's the way I would try to talk about it.
Okay, I got it. I think, yeah, we can put that in the paper at least, because there are constraints, as we pointed out, in the empirical measure. But having said that, I think this was the best that we could do. We'll try to consolidate it with the theoretically what it should be.
Because in some industries in the US, like say retail, they do provide sort of, information on revenues per square foot, and you do have it and stuff like that. So I'm just not, I think it's useful to have the theoretical benchmark that you would want ideally, and then talk about what disclosures might provide.
Okay.
Right. I mean, we could go to price disclosures instead of quantity disclosures. That too, and so on.
Right. Okay. Thanks, Aditya. I mean, this was just one example. Yeah, I mean, for some firms, it will not be, the unit of measurements will change, but maybe I can put up more examples on that. Okay, so I'll go ahead. So we have on the market reaction test and the revenue forecast test, we are looking at like a time period of from 2007 to 16, 5 years before and 5 years after. I'll come to the design part of it. And there we have roughly these many observations. These are the summary statistics. We have the percentage change in sales, quantity, price, then the quantity growth factor. As Ayung, you mentioned, it can definitely go above 1. But I think I didn't mean to say that 1 is the highest value, but what I meant was, if it is an increase, it might actually denote a drive in the sales growth, mostly because of the quantity growth rather than the price growth. So in the median portions, we have roughly 9.5% sales growth divided into quantity growth of 5 and price growth of 3. And I think this left, whatever is left, like 1.3% is what I think, Sudipta, you were referring to in terms of the third term, which is the product of both of this. For our CAR measures, we have used a whole host of measures, CAPM, 3-factor, 4-factor, and we have a bunch of controls too. So what information? So initially, the first stage test that we do is what exactly is the information that is there in this quantity disclosures. So before going into the quantity demand factor and the proportion of quantity growth in the sales growth, we do a basic test, a sanity test of trying to find out how sales are correlated in the future periods. So basically, we do an autoregressive model where we check how the sales growth in the next period is dependent on the sales growth in the current period. So here I, J, and T is basically the firm, product, and the year level. We use the firm fixed effects product and the year level fixed effects, and we use control variables to control for size, profitability, industry level competition, market share of the firm stuff. And what we usually find is that there is a negative coefficient. That is, the sales growth in the future period kind of tends to mean revert. So now this entire model is where we have not given any input in terms of what are the price and the quantity growth. We are just playing on the sales growth. And what we find is there is as expected, there is a sales growth mean reversion. So the next model what we do is we include this quantity growth factor, which as I was proxying it for demand shift or the change in demand or the change in quantity growth relative to the change in sales growth. So that we interact in the right side. And this is the kind of regression it looks like. So basically, we have interacted this quantity growth factor with our main independent variable, which is the current sales. And the dependent variable is the future sales. These are the three terms. These are the results that we have. So first, let's focus on the standalone term, that is the current sales growth. So the current sales growth is still related to the future sales growth in a negative manner, which is the mean reversion that we are talking about. What it means is basically in terms of economic magnitude, for if there is a median level current year sales growth, which is roughly 8.4 percentage points, this coefficient suggests that there will be a minus 1.85 percentage points. That is a decline in 1.85 percentage points in sales growth simply because of the current sales growth. That is the sales growth without growth in quantity. It just shows a mean reversion. Now coming to the additional terms that we have, let's talk about the first one, which is the quantity growth factor. Here we have a strong positive coefficient, which suggests that the mean reversion in sales growth that we saw in the third term is basically kind of moderated when we have a higher quantity growth factor. If I take a quantity growth factor of 1, which is the hypothetical or the case where the entire sales growth is because of the quantity growth, we find that or I can also term it as a demand shock. In that case, we find that the revenue growth leads to 0.97 percentage points increase in the next year's revenue growth. Now coming, the more interesting thing is the third term, which is the interaction of both of this. This talks about what happens to the mean reversion when the sales is basically driven by quantity changes. So in this case, we have a strong positive coefficient. In terms of economic magnitude, assuming that say a firm went from entirely price-led growth to quantity-led growth. In that case, the QF will change from 0 to 1, right? In that case, for a median level current period sales growth of 8.4 percentage points, we show that there is a 0.77 percentage points revenue growth in the future period. So if I have to take this combinedly, imagine that the quantity growth factor is 0. That is, the sales is completely generated by price growth. That's what it would mean. In that case, sales will have a mean reversion, a negative coefficient. But when we have a positive quantity growth factor, a value of say a perfect 1, in that case, what happens is this mean reversion tends to be moderated. It is less. So taken combinedly, if I add all these magnitudes, what I find is in the case where only price changes were there but no quantity changes, we expected a 1.85 percentage point decline in the future sales growth, but that is now just 0.11 percentage point decline. So the decline in sales growth is very less as compared to the previous case. So what it means is the revenue growth driven by the shift in demands kind of persists. It doesn't go to the mean reversion anymore. Yes, I.
So when I was looking at your example, right, companies will have disclosed 2 columns. One is the dollar value of revenue. The other one will be just a revenue quantity. And initially, before I look at your table, I thought that you will have just 2 right-hand side variable. One is just the growth in dollar value of sales. The other one is just the growth in the sales quantity. And if you put both variables there, the dollar value will capture just the selling price impact. And then because quantity will just capture the quantity. So I think that would simplify your current model, which has 3 variables, and then also with the interaction term, right? So if you do have the quantity data, then you should see the quantity variable, growth variable should have a positive coefficient. And what's left in the dollar value of sales growth will be negative that capture the selling prices actually tend to be transitory or mean reversion.
Okay.
I don't know whether that will make, if data is available, that
Okay.
would make the empirical model easier to interpret instead of like coming up with that fraction, right? That is incomplete because you also need to think about the interaction term. Yep.
Right.
Potentially,
So-
it's just a minor suggestion, but
yeah.
it's just easier
Yeah,
for
then-
readers to interpret your
Mhm.
story. Yep.
Right. So if I get it correctly, you're just saying, why not just regress the sales growth on, say, don't go into the fraction, just do it on quantity and sales.
Yeah.
Okay. Okay. So like percentage sales growth in the next period on, say, percentage sales growth in the current period and percentage quantity growth in the current period. That way. Yeah. Okay. All right. Yeah, I think can do that. Okay. Thanks, Anne. I think can check that. Yes, Sudipta.
So I have another question. You keep referring to the quantity increase as coming from demand changes. I'm not sure how you're identifying that from supply changes. So if I think of a standard demand supply graph, quantity increase, let's say, could be because supply increase or demand increase. So if you hold the supply demand curve constant, what you'd expect is that when demand increases, price falls. This is the situation Ayung was discussing
Right.
much earlier.
Right.
But to talk about a demand increase, you're moving along the supply curve. So you should expect both a price increase and a quantity increase, or both a price decrease and a quantity decrease. So until you sort of identify where these firms are falling into that 2x2 quadrant,
Right.
it's sort of difficult for me to sort of attribute all demand increases, all quantity increases to demand changes.
Right.
I think you have to be much more careful
Yes.
if talking and writing mode.
Yeah. Thanks, Udit. I think that's a good point. Maybe I should tone down on the demand shift term. But yeah, I think, and we actually went ahead and checked it in the 4 quadrants when there is say price and quantity increases, price and quantity both decreases, one increases, the other decreases, and the 4 quadrants. And we did find a stronger relation in the in those quadrants where both of them are in the same direction, which basically, as you said, which are like which would denote demand shifts.
Yeah, so I think that's really important. I mean,
That's
in terms of
okay.
how we're predicting the future. I mean, if
Right. I think we can then put that. I mean, we are debating about whether to put it. Yeah, I think. Yeah, we came across that, and thank you for bringing it up. But I should be a little more careful in using the term demand shift. Okay. Thanks, Adit. All right. So essentially what we show here is the persistence of sales growth is higher when we have a sales growth that is due to quantity growth rather than price growth. Then we go ahead and check, how long does the quantity effect actually persist? So in this case, what we take is we take the sales growth, the future sales growth, and we regress it on past quantity growth for several lag periods and past sales growth for several lag periods. I think, Ayung, you are referring to something like this kind of a regression with not having too many past periods. So we can, we can definitely put that in. That makes it easier to understand. So what we are exactly checking here is this is like an impulse response function. We are checking, how the previous quantity growths are loading on the future sales growth, and similarly how the previous several lagged period sales growth are loading on the future sales growth. So we have we've deployed it in a graph, and what we find is the quantity growth actually reflects revenue growth, and it persists for up to 5 years when we find that the coefficient is still significant and positive. But when we do it for, say, lagged revenue growth, we see that there is a consistent negative relation between current sales growth and the past sales growth, but that the magnitude kind of reduces as you move on to, higher lagged values, very down the line old lagged values. So essentially what we show here is this impact of the quantity growth on sales growth is not just a short-term phenomenon, it actually persists for quite some time. Then we do a cross-sectional test. We try to find out, whether quantity effect is similar in the cases of monopoly markets versus competitive markets. So to basically give you an idea, firms in monopoly markets are in general price setters, versus firms in competitive markets are price takers. So the idea is, if the firm is facing less competition, say in a monopoly market, it may generate higher revenue growth through price growth too. It doesn't have to be only quantity growth, because they can actually stop production when their marginal revenue is equal to marginal cost, and they might actually charge higher and get higher abnormal profits. So in the cross-section test, what we try to find out is the quantity effect that we are showing, which leads to persistent revenue growth, is that effect lower in monopoly firms as compared to competitive firms? So for this test, what we do is we calculate the HHI of the industries and we interact it with our persistent variable. So this persistent model which we had showed with the double interaction, and then the triple interaction we are multiplying with the HHI of the industry. And what we find is, if there is a one standard deviation increase in the HHI value of the industry, it leads to a 75% decline in the persistence of revenue growth. So basically, one standard deviation of HHI is somewhere around about 650 or something. So it kind of eats away the persistence that we are showing. So in essence, what we are trying to show here is the quantity effect that we are showing. It usually holds more effectively for firms in competitive markets than firms in markets that have less competition, or basically say like monopoly kind of markets. In the second set of tests, we go on to see whether there is some market relevant value of this information. So we check informational efficiency of these disclosures. We conduct two set of tests. The first thing is we directly check, what happens to the analyst revenue forecast. So do these disclosures reduce the analyst revenue forecast errors? So we take a DID kind of setting from 2007 to 16, 5 years before and 5 years after. Now there is no clear identification per se, because all the manufacturing firms are mandated to disclose and then stop disclosing. So what we do is for identification, we use the service industry firms as the kind of control firms which don't go through it. So basically, they don't have to disclose neither in the pre-period nor in the post-period, but the manufacturing firms have to disclose in the pre-period and not disclose in the post-period. So we design an DID around that, and the variable that we are examining is the absolute revenue surprise, or the revenue forecast error. And what we find is this revenue forecast error goes up significantly. There's a 1.48 times increase in the sizes of the errors after the discontinuation of the disclosures. And these results are unlikely due to any kind of pre-existing trends. We do a pre-trend test as well. So disclosure of product level quantity and revenue information perhaps improved informational efficiency in the pre-period. In the second set of tests, we examine what is the effect on of these disclosures on market reactions in and around earnings announcements. Do these disclosures improve the stock price efficiency? So we conduct event study around earnings announcement days. We calculate the cumulative abnormal returns. We use different factors, and we try to examine what happens to the magnitude of these cumulative abnormal returns in the post period as compared to the pre period. Yes, Mark.
A question about your prior slide about the discontinuation of the mandatory disclosure requirement. Do you have a sense of approximately like what percentage of firms or something like that continued to provide the disclosure even when it was no longer mandatory?
Right. So in 2011, they stopped disclosing. In 2012, found that 21% still disclosed. but
Okay.
it went down monotonically. By the end of 5 years, there are only 9% firms which were disclosing voluntarily.
Wow, that's interesting. So do you have a sense where firms lobbying against it are going proprietary information or giving information to competitors? Do you have a
Okay.
sense like what the big pushback was?
No, we are actually, I'll have to, what was the kind of pushback, but basically this came as, I'll give you some kind of institutional background. So there was this idea that if you move to IFRS, your, FDIs into the country will grow. If you move to a international reporting standard. So that was the idea behind this regulation. And I think there are several papers which show that what happens when European countries moved from their local accounting regulation to the IFRS, and it basically there is higher because the financial statements becomes more comparable, more easy to read. So that was the motivation behind moving it to it, moving it towards towards a format which looks similar to IFRS. But whether there was company pushbacks and all, we're not exactly clear. We can check.
In addition to that, it'd be interesting if investors were cared about the loss of this disclosure, things like that. But
Right. Yeah.
great, thank you.
Thanks, Mark. Yes, Sudipta.
So following up on that, I mean, India started allowing voluntary IFRS adoption in 2010.
Right.
So there's some potentially endogenous replacement of sort of revenue data with other IFRS mandated data that wasn't part of Indian GAAP. So I think one way to get at this might be to just look at earnings forecasts too. If the earnings forecasts are not getting worse, that means that there's an offset. But if earnings forecasts are getting worse alongside the revenue forecast, then it suggests that there's actually some cost, because there's a cost data and there's revenue data.
Right.
You're focusing on the revenue side, but it's possible that there's more cost data coming out, which helps with earnings forecasting. So they could be offsetting.
Right. Thanks a
So
lot for bringing
that
that up.
helps you identify at least, the combination of the revenue and the earnings data.
Right.
Would help
So
identify.
we did check on the earnings data, and that was not something that was changing. It was totally insignificant. Right. Center. So.
And there's an interpretation of there's a substitution of cost information for revenue information. And so
okay,
it could be something like Ayn was talking about with capital expenditures and depreciation. It could be other stuff, but I don't know, but I think it's worth looking into why.
Okay.
I mean, that has more to do with the accounting design project in the sense of, are you really adding information or are you just substituting information?
Right. Okay, so we'll have a closer look at maybe the earnings forecast. What happens there? So, but the first test, whatever we did, so we didn't find anything. But I can have a closer look. It can have a lot of impact, like like on the capex and the cost predictions and stuff. Thanks, Udita. So the second set of market efficiency tests was around stock price efficiency. So yeah, so we tried to find out what is this magnitude of cumulative abnormal returns around these windows in the pre-period versus the post-period for all the manufacturing firms. And what we find is significantly the post-period cumulative abnormal returns seem to be higher in size than the pre-period cumulative abnormal returns, which suggests that these disclosures actually maybe improved stock market efficiency in the pre-period. To rule out that this could just be a trend, maybe all the companies witnessed a higher cumulative.
May I? Sorry, okay, 1 minute remaining.
Pardon me?
Yeah.
Oh, okay. Thanks, Aruba. Okay, thank you. So we also check whether, for service industry firms, and there is no such changes in the magnitudes of cumulative abnormal returns. So we also do that in a DID setting, the way we did for the revenue surprises, and we find the similar results. That is basically removal of this product disclosures results in a higher abnormal returns around earnings announcement dates. We do some alternate identifications because manufacturing and services might not be similar. One interesting one is where we take the firms that belong to the PPI, that is the and as treated firms, and CPI industries as the control firm. CPI is your consumer price index. The intuition is that the products that are there in the CPI industries are basically getting information about their prices is way easier than getting the price information of PPI products. And we find similar results here with an alternate identification. Similarly, we do some mass sample tests based on entropy balancing technique, and we get results remain similar. We also talk about voluntary disclosure. I think Mark asked about it. So we saw that it's the disclosure is actually monotonically reducing.
Sorry.
But yeah.
Time is up. So may I finish?
Yes.
Okay. Okay.
So yeah,
Okay.
basically, that's the conclusion that we have. That these things are informative, and it talks about demand of the product, or basically quantity growth does drive sales growth a lot more, and it has market implications. And it might be something that global regulators might want to have a look at it if such kind of disclosures may be mandated or something. And yeah, and that's the next event that is there on December 10th. Professor Stephen will be talking about his paper on accounting for carbon. Thank you again for this opportunity to present, and these are very valuable comments. I'm really glad that I'm presenting here, and we'll try to incorporate as much as we can. And thank you very much.